Hello traders, it's Saturday, January the 25th. This is John Kicklighter, Chief Strategist for DailyFX.com, here with your weekend wrap-up and an outlook for what we can expect in the week ahead. I don't need to tell you if you've been looking at charts or if you've been placing trades that we've had an exceptional week this past week, and given the level of event risk that we are heading into next, or the upcoming week, is probably going to be just as remarkable, just as potentially market-moving. More importantly, though, I think that with the event risk that we have ahead, that we can transition from just an exceptional bout of volatility into something more along the lines of consistent trend generation. If the cards fall properly, it could be a significant unwinding of risk. All right, so that deleveraging that we have been concerned could happen may very well take place. Now, in synopses of last week, or this week we've just closed, I think we can look at one chart and get a good sense of where the market's assumptions lie. The S&P 500. As we were talking about, actually one of the strategy videos I made this past week was how the S&P 500 was an inevitable break. And you can see that being the case because the technical pattern simply was running out of room. Now, just because you have a technical break does not necessarily mean that it has to be a severe one, much less does it have to have trend follow through. But as it happens, we have at least the first part of that, and it was because the instigation of the break. I want to use this as kind of a lesson. When we have technicals, a lot of you trade on technicals, and I know I trade on technicals, it is very useful to locate these situations. Now, the best means of actually having a trade setup that is not just a short-term break, but the kind of break that would offer some meaningful follow-through, if not a trend, you have to align those technical situations with the proper fundamental catalysts and the proper market backdrop. All right, market backdrop being good for the trend generation. You can see this break and you can see the severity of this particular move. In fact, I've measured it out for you, and it is well over 1.5%. I actually have here in the measure of change, these are all instances where we've had moves up or down over 1.5%. This was actually the biggest drop we've seen since June. All right, so quite the move. An incredible move. And the move that we had back in June that matched that is a little bit bigger than this was essentially the ending move of the correction that we had back then. We have not seen a break to the downside that has much follow through beyond this exceptional volatility here. So the coming week is quite important. So to give you a sense, the big dramatic nearly 2.5% move that we had back here, all right, look how much follow through we had after that. Not much. That was the exhaustion of the move. Similar to here, all right, similar to here, here, and even here, although you had a little bit more follow through. If we want this to change, change tack, change trend, we need to not just play or cater to that technical break, we must see the markets truly pick up risk aversion. And I don't have to go through the charts because I go through them enough, though I will look at a couple of them. We have the backdrop for these conditions. We have the exceptional use of leverage. We have the exceptionally low level of participation. We have markets in which investors have really leveraged themselves into everything risky. All right, this just happens to be high-yield ETFs and emerging market bonds, but there is a sliding scale of risk, and that's why I keep this particular measure up to date. This is a measure of risk across the spectrum. Common assets that investors flock towards when they are trying to make a greater rate of return. All right. Now, this past week, we've been talking about the exceptional volatility of the emerging markets. All right. And indeed, the strategy video that I put out earlier is actually about the emerging markets. Here you see the dollar Argentine peso, which has been the big story of this past week. It's not just related to the Argentine peso, though. We can see the concern spreading to other areas of the emerging market. The Turkish lira. We also saw the Brazilian real, the Indian rupee. Do recall that the Indian rupee was catering towards some level of crisis not too long ago. Back in August, actually, we had a severe decrease in the rupee as investors were pulling their money out of that market. But when we look back at the influence that that had on general conditions, all right, this is the S&P 500. This is our high watermark for market impact. You might have helped contribute some of this pullback, but it really didn't instigate a critical break, although this was a modest break right here, and did certainly not provide the necessary trend reversal. Now we do see that the emerging markets are pulling back. They're not pulling back in a severe way. All right, and this is actually, the orange line is, as I usually color code these things, a volatility index, and volatility index specifically for the emerging markets. You can see that, since I flipped it upside down, when this particular reading falls, it means risk appetite's dropping or fear is rising. And it is picking up, but it is not picking up in a really significant way. This is why I want us to be a little bit cautious, all right? Because you have to scale higher and higher into the risk spectrum if you want to see not just a little bit of follow through, but if you want to see a full-blown trend, you have to see risk aversion spreading to the rest of the markets, and not just the emerging markets, the developed markets. Very important. Now, when we see these riskier assets start to come apart, which is what we're doing, you can see that some things are going to have a material impact from it. You do have here the S&P 500 pulling back. You have world global equities pulling back. Of course, the emerging markets have been trending lower for a couple of months, actually. And my risk-reward index has actually had a tremendous drop to the downside. But these are markets that are a little bit more sensitive to changes in risk. The S&P 500 is just off record highs. Of course it's going to be very sensitive to changes in risk like this. All right? It is definitely going to get a pullback of that magnitude. Same will be true with the yen-based crosses. All right? The yen-based crosses are the FX equivalent of the equity market. They are exceptionally expensive. All right? It doesn't mean they can't continue to rise, but after the incredible performance they've put in since September 2012, in the lead up to the first open-ended stimulus program from the Bank of Japan, they've already priced in a lot of depreciation for the Japanese yen. And traditionally we trade these yen crosses for the carry trade. But as we know, we well know, the carry trade is not there. We're not making carry on these positions. They just don't provide. Historically, they're extremely low. So what are we looking for in the yen crosses? Why have people plowed so much capital behind that position? Well, because they've been rising. You buy into a rising market, just like people have been doing with the S&P 500, especially if you assume that monetary policy would consistently drive that market forward. Right? This has been the basis of expectations for the yen crosses. Well, as we know with the recent Bank of Japan rate decision, they didn't give us any kind of upgrade to stimulus programs, nor did they give us any reason to expect an immediate upgrade to that QE program. All right? This is actually somewhat disheartening to many long yen cross traders, because they presumed that this was a sure thing. But now they're not so certain. And especially as we start to see a pickup in volatility, these kind of positions that are just sit and hold become much more dangerous. So these pairs, these yen crosses, are going to be far more sensitive to the lower end, or the more volatile end of the risk spectrum. So in the circumstance that we'll talk about this circumstance because it's a good probability. In the probability or scenario where risk trends do stabilize and bounce somewhat, which is a possibility, because in the upcoming week's docket, the calendar is going to be loaded, by the way, and we'll look at some more of this event risk, but in the upcoming docket, Monday is very, very thin on event risk. All right? And that is itself not necessarily something that can slow and stop the market, but knowing that we have bigger event risk later down the line, EU finance ministers meeting, the UK GDP, right? Most importantly, Wednesday's FOMC rate decision, a bank review for Spain, all right? The data just keeps on coming. US GDP, Japanese inflation, Eurozone unemployment. All right, these are very important factors, very important catalysts later down in the week. But in the first 24 to 48 hours, things are relatively light. All right, that can lead markets to pull back on the big unwinding of risk trends. Perhaps they'll wait to see what happens with the event risk that's due later in the week. If you do have a stabilization or possible bounce in risk trends, be very cautious of these yen crosses. All right. While they're very sensitive to the drawdown, they can also be very sensitive to the bounce. All right. This is, I know, against what a lot of us want because we've been looking at pairs like this Kiwi yen, which I've highlighted a while ago. We've been waiting for this break for some time, and that is a beautiful technical pattern. Head and shoulders, breaking that neckline, a good 100+ point move to the downside. Perfect technical bearings. But you have to be very cautious of the market conditions, which would see potentially trend dry out in the first 48 hours of next week, and then fundamental conditions where catalysts can turn this around, and that is a very big concern. So be cautious of your Kiwi yen, CAD yen, Aussie yen. These high yield yen crosses have made some very tremendous breaks, and they certainly have rebound opportunities to them. They are not my favorite rebound opportunities, however. If I want a rebound opportunity, I want a currency pair that not is only sensitive to the yen cross in condition to risk trends. I also want something that has a reason to be long the counter currency, the dollar. All right, the dollar is looking at some great potential for a advance on a risk stabilization. All right, because even if we get stable markets, even if we get risk aversion, we're still likely to see, regardless of that direction, a FOMC taper. All right. In fact, the market is pricing in a expectation of a steady taper over the subsequent meetings. All right. This is a very good thing because, or at least for the dollar, it is, because as the taper continues, it lifts U.S. interest rates, but at the same time, volatility is something that can help the dollar perform. All right? If risk aversion kicks in, that's another thing that helps the dollar. So there's two factors that help the dollar under different circumstances. Now the issue that would obviously occur here is that if there were full-blown risk aversion and the yen crosses continue to drop, this is probably going to drop too. It won't drop as severely as some of its counterparts, but it will drop, because it is in the same set of circumstances as the rest of the yen crosses. It is overvalued for what the expectations are, for what the actual payout is. All right. Now, in a risk-averse world, I would not prefer the dollar-yen because obviously it's got some controversial factors on both sides. My preference for a yen cross on the continuation, it wouldn't be the high-yield currencies either because you're going to be paying the carry, and they are already significantly retraced. I like the euro-yen. All right, because this thing has been building up for so long that it has a lot of unwinding it can still do. All right? In fact, in the rankings, it is the most overvalued of these crosses. The pound yen is also of particular interest to me because it does have similar buildup and has a lot of room that it can unwind. They also happen to have great technical patterns, head and shoulders, all right? Just barely nudge below those necklines, but that is exactly what I want to see. Trying to jump in now on an Aussie yen or a Kiwi yen, that's a little bit more aggressive. If these are slow to follow, but they have followed through, these are more close to a combination of technical, fundamental, and market conditions that I look for in trades. All right? Now, as I said, if you want to see just more than volatility for the yen crosses, these just breakouts that go, if they potentially go nowhere, the S&P 500, if it's just a break that goes nowhere, if you want to see instead something that has follow through and genuine trend development for something that has been long building up for one side, all right, a reversal from these markets and a deleveraging of risk, that has great potential behind it. Its probability is still probably less than 50-50. All right, so you have to be able to balance the potential from a trade and the probability of a trade. But nevertheless, the potential is just so large that it's critical that we have a strategy available and ready regardless of what the circumstance ends up being. But in a risk-averse scenario, all right, we have to measure the level of or intensity of risk aversion. All right, we're looking at our standard measures. We have the S&P 500, and actually this is change up here, this light blue line. Anything over 2.5% I measure in a weekly performance. This was the biggest weekly drop that we've seen in approximately 2 years. All right. I also have this red line where we've had a both 2.5% decline on a week and a more than 30% increase in the VIX index. All right, that would tell me that there is some pretty exceptional market movement, pretty exceptional volatility. You can see that this has happened not many times over the past 7 or so years, so this is quite a remarkable event. And we haven't had this combination of factors since back during the crisis of 2011, all right, back when the U.S. was downgraded by Standard & Poor's. So this is our standard measure. Yes, this is sensitive enough that it can have that initial move. But this is only one step. The next step up is seeing emerging markets or something that spreads around the world. Of course, emerging markets may actually be the catalyst this time around for the S&P 500, but we know that the emerging market volatility index is picking up. Concerns are increasing. So then we look to more of the bigger markets. All right, this is still an emerging market, but this is the Chinese financial system. We've been recently seeing a big pickup in the Chinese 7-day repo rate. Well, what is that? That is just the cost of funding. All right, that's the standard cost of funding. When we see that that rate is picking up, that tells us that there are some troubles in the financial system. And as you can see, I actually flip the interest rate upside down. As you see, when those rates increase, it is often the instigator for some pretty remarkable declines in Chinese equities. Now, as we know, Chinese uncertainties can be significant catalysts for problems across the world in global financial confidence, because investors, let's say in the UK, have a lot of investments in China, the United States, Japan, Europe, all right? And when one of those major sectors start to come apart, then we see that capital start flowing in or repatriated from all over. All right, so we do know that at the end of this month, or so next week, we have the maturation of a very important trust in China. It's essentially a investment vehicle that is coming due, and it has nearly 500 million that needs to be paid out, which it looks like it's essentially going to default. Right? If China allows us to default, that can be another factor that kind of weighs in on this bigger fundamental picture. I also want you to look at the Eurozone. All right, now we're starting to get into funding markets. All right, the major developed countries. We've recently seen funding pressure in the European Union. As we measure here, this is the EONA and ECB funding rate. So what that tells us is the cost of borrowing on the open market versus the cost of borrowing at essentially the ECB's risk-free rate. When we see this cross, that is a concern. That was what essentially instigated the LTRO programs back in 2011-2012. Will the ECB pay attention? Will they do something about this? We'll have to see, but they've been backing off. Just like the Bank of Japan has backed off the possibility of upgrading QE upgrade. The Fed is talking about tapering. The Bank of England is expected to start discussing rate hikes. Right? Monetary policy is pulling back. That is a big concern, especially when people have to evaluate the situation when we see markets like this. And of course, the greatest risk or threat is funding pressure in the United States. Right? Funding pressure in the United States tells us that capital is just flowing into the U.S. looking for liquidity, and that's when we have blind panic. That's fear. All right? We have some hiccups going on. And I measure this through the 1 month, 3 month spread, and what that tells us is that there is some kind of event that is pushing people further and further towards shorter term government bonds, which in turn is essentially what we call cash equivalent, is what people want when they absolutely must have liquidity. Right? That's a great measure of fear. But as you can see, we have a few hiccups, but not necessarily getting that drastic. However, the funding concerns that we are seeing in the multiple regions is just a patchwork of problems that can ultimately come back together. If that does indeed prove the case, this not only will this continue, but we will see risk trends spread more efficiently and effectively across the board. We will see these broader asset classes respond as they would for risk. All right. Now, one big play in the FX market, or one of the best positioned currencies, is going to be the dollar. Right. As I said, the U.S. dollar is going to potentially benefit for its reflections on risk. All right. In fact, let me show you this chart. The U.S. dollar versus the risk-reward index that I cater here, just a measure of volatility and return. Big drop in risk-reward, or if you, since I flipped it upside down, reward-risk. Big increase helps the U.S. dollar. It means fear is starting to pick up. The dollar has been a little bit quiet to start off, but that's because we're looking for the conviction in this move. And also the markets are distracted by what we have coming up. That FOMC rate decision is going to be a huge piece of event risk for us next week. All right. If they continue with the taper, this will be an impact that can actually increase shorter and medium-term rates for the United States. All right. We'll start eventually talking about the possibility of rate hikes. And more importantly, it can also feed markets risk aversion, because we know how important the expectations of stimulus, not just the Fed stimulus, but global stimulus, is to investors taking positions. We can see it quite clearly on the S&P 500 and the yen crosses. But now not only do we have the Fed talking taper, but we have the other major central banks that are not stepping in to replace their absence. All right? This can easily turn into a much more dire situation. But as I said, risk aversion is something the dollar takes well to. Higher yields is something any currency would take well to, as long as risk aversion is not too dramatic. All right, so that is a good bearing on both accounts. That is exactly the reason why I look at the dollar-yen and I like it to the upside if there is a bounce. Of course, if it's risk aversion, a little bit of a confused currency pair. The only trade I'm still holding I held into the weekend was my Aussie dollar short. All right, and this has good risk aversion counter appeal to it. Obviously, high yield currency. And even if we were talking about monetary policy, the market still hung up on interest rate cut expectations from the RBA. Whether they make sense or not, that's what the market believes, and that's what's going to drive the market's price. All right. The other position that I had that got knocked out actually by 1.5 pips, and I know these happen, and we get really upset about it, but we have to just let it go, is the Euro USD. I still think this has great potential going into next week. Actually, adding this technical jump that we had here, this is a 4-hour chart, by the way. Adding that in consideration to the picture, I think it has even more opportunity to pull back to the downside. If I were to go a lower time frame chart, it would look a lot like a very dramatic head and shoulders pattern with a neckline right here at about 136.70, 136.60. All right, I'm going to be looking for this to break next week. The dollar is going to look better against the Eurozone or the Euro under both circumstances. Risk aversion, the FOMC taper, the off chance that they don't taper, that would be a negative outcome for the dollar, but the likelihood of that is pretty low, which is something to say considering where we were with eventually coming to that taper and how long it took. All right. And the euro side of things, the market is just too leveraged on their expectations. The conditions in the eurozone are certainly unstable. All right, they're going to destabilize themselves because all that capital flow that's flowed into the periphery of Spain and Italy, all right, driving their yields down. That was speculative inflow. That's like investors who drove into the yen crosses. That's like investors who driven into stocks. All right, they were trying to get whatever rate of return they could. Well, the rate of return is exceptionally low, and volatility is starting to pick up. All right, so this euro dollar looks great if it breaks to the downside. I'll be keeping an eye on this, and I will trade it early in the week if it starts to make a move. A lot of people were looking at the pound dollar. That was a big pullback, and it's acted very erratic, and that pullback to the downside is encouraging, but I'm still going to wait for a more substantial break, probably below the 163 level, because we have, in addition to the Fed rate decision, the US GDP, we have the UK GDP on Tuesday. If this comes out to be very strong, all right, even though we have risk aversion themes, and even though the dollar looks good, the British pound can rally quite hard. A lot of people are making significant hay out of Carney's suggestion that the Bank of England does not have to raise rates even after they hit their 7% target. We know that, all right. But what Carney is going to have to do is change his forward guidance. There's nothing he can do because you can't just sit on an unemployment rate close to 6% throughout 2014 because you didn't want to move when you set in line with the target that you gave. So either he has to hike or he has to change his forward guidance. Right? They're backed into a difficult position. The market knows this, and they're pricing in quite a bit for the pound. Now, I think they're pricing in too much. I think that actually the forward guidance is what changes, and that would lead to a pound drop. But until it's clarified, the pound might not give up its gains. So be very careful with the pound dollar. I know it's some of your guys' favorite trade out there. And I do want to point out a number of opportunities that fall outside the lines of the standard pairs we've been watching. I know there's a lot of potential in pound dollar, Aussie dollar, euro dollar, dollar yen, all the yen crosses, really great potential, but I want you to look at some of the unusual ones. It will take you further away from the basic risk on, risk off, which is going to be very erratic, and it could cost you a lot if you leverage into the same kind of theme across multiple pairs. All right, so diversify a little bit. Look at pairs like pound kiwi. Look at this. Head and shoulders, or you can call it a triple top, but more importantly, it's a larger wedge formation. And this is a very long-term slow turn it's making. So there's a lot of potential here, whether this turns out to be a range. You can see this is about 800 pips or 900 pips. That's a huge range. Or it can be a break to the upside and continue a much bigger trend. Pound Aussie, huge 38.2 fib. Not looking for, many people see this and they say, oh, this is an instant reversal. No, not necessarily. All right, picking tops and bottoms is a very difficult thing to do. Has to have all the factors align perfectly, and that does not happen very often. Typically, it's best to go with the flow. But this is something that we can keep in mind. This is a big development. All right, you can also look at the Euro Kiwi, which I decided through Friday that I didn't want to push this too far. It started to top out a little bit, so I took it off at 255 pips the second half of the trade. So the first half was 100 pips, second half 255 pips. This was a great trade for me. It offset the 50 that I lost on the Euro USD as it had that big tail. So this was a good general setup and outside of the norm that we usually look for. But I want to see where it goes from here. This is a more of a erratic currency pair. It's better suited for ranges, and we will see if there's more circumstance, more opportunity for it next week. Euro Aussie is just like the pound Aussie, very aggressively positioned. And then, of course, there are also pairs that help to work off or negate risk trends. Aussie and the Canadian dollar are both on the negative side of interest rate expectations. These are some very prominent swings, very hardy swings. And look at that. They're pretty consistent, holding up to technicals really well. All right. A lot of people aren't paying attention to this. This has great potential. And then, of course, there are the commodity markets. Gold nudged below, above that trend line. All right. So we're starting to see some development here. The only problem with gold, and it does do well during instability, especially in the fiat markets, the exchange rate markets, and that emerging market concern is certainly kicking in to boost the appeal of gold, as well as equities dropping. But if the dollar starts to pick up, all right, if people really want liquidity, they're not going to fool around with gold. This is not like that anymore. After that 14% drop in 2 days back in April, people do not mess around with gold because it does not have that level of liquidity. They would prefer the US dollar. So if this starts picking up, be very careful about your gold expectations. All right. There's so much more we can talk about in so many scenarios, but keep the bigger picture in mind. We are looking at the general health of risk trends, whether it can just turn from breakout to true trend, and what it would impact, like the US dollar, and the fact that we have a dearth of scheduled event risk. A lot to be careful of. All right. So be prepared next week with trades and set up your scenarios ahead of time. When you see those factors fall in line for you, whichever scenario you have, execute what you already have planned. All right. We'll wrap it up there. I hope you have a fantastic weekend, and I hope you're prepared come Monday. Good luck trading out there, guys, and I'll talk to you once again on Monday.